Hey people, welcome to another Everyday Trader. This is your host Eric Hale. I'm not joined by Greg today because he had a dentist appointment yesterday. Told me that he went in and ended up needing a little bit more work than anticipated. So he had a root canal yesterday and is recovering, and he's supposed to be having another one again next week. So yeah, that's lovely things when you go to the dentist office. But still wanted to touch base with you folks and just talk real quick about the markets this week. We had some very significant things happen this week, and I think it was a turning point. Some of the most significant news that happened. So two big things that happened this week. First of all was the consumer price index inflation measure, which was something we had all been looking at. So the Bureau of Labor Statistics reported that, let me get this, let's do that, there you go. So the Bureau of Labor Statistics reported a month-over-month increase of 0.1%, or core, which takes out energy and food, was 0.4% month-over-month increase. We can take a look at those numbers. I like to pop these into an Excel spreadsheet, and I know that's probably a lot to look at there. So the list of items that are in the BLS report, this is the table 6, which is the month-over-month changes. There's a year-over-year, but I think month-over-month is what we want to look at. Here's all the different items that go into CPI. You can see all kinds of things, everything from intracity transport, floor coverings, motor oils, potatoes. How does potatoes... oh no, I guess it's because of the way they're sorted. Okay, so these are actually sorted. I changed the sort order here. These are sorted by weight. So yeah, so what do we see happen this week? If I put these in a pivot table and sort based on weighting, so the most important things are at the top. So most important is rent of shelter, right? So that 34.195% of the CPI is the weighting of rent of shelter. Then medical care, transportation services, communication services go here. So I like to sort these based on the weighting, the importance weighting, and then also graph and look at. So the most important stuff is at the top, and overall there's that 0.1% month over month. Rent of shelter up pretty significant. I mean, a 0.5% increase is 6% annualized. So it's a pretty significant increase. But things have been coming down a little bit in that space. Medical care has been low. That's due to some quirks that happened due to healthcare cost. Transportation services were a little bit higher. One of the factors that went into that was a big adjustment in car insurance. Not sure how that plays out. Maybe take a look at Geico or Progressive or somebody, or Allstate. I don't know. I haven't really thought through that one a lot, but that was one of the key points that was highlighted in the increases in the, so shelter, used cars, motor vehicle insurance was one of the biggest changes that happened month over month. But when I look at this overall chart, it feels like different than we've seen over the past few months, and that is that we are seeing what I think overall is an increase. Finally, we're making some headway on inflation coming down. So that CPI report came out on Tuesday. Wednesday was the FOMC meeting where we announced a skip, right? So this carefully worded statement, but it seemed pretty confident that the market is expecting a rate increase. In fact, we're at a 74% probability of a rate hike. So 74, it was 67% yesterday of a rate hike in the next meeting, which is July 26th. It's very much what the market wanted, and my perception is that the Fed sort of capitulated to the market and people and what they were asking for. So They didn't signal a pause. And in fact, they made it pretty clear they're looking at another 50%, 50 basis point that's probably going to happen. So probably one in July. We'll probably skip in September and do another one in November. And if you look at the overall probabilities of where the Fed funds rate will be, we're not showing a cut. This was, previously people were saying that, oh, the market's pricing in a cut. First of all, there's some limitations in how these probabilities are calculated. We need to take them with a grain of salt. But very clearly, we can see that the forecast is actually for a rate increase and maybe even two, and no cut until 2024. So I think that's probably more realistic. So we've gotten a couple of really big things out of the way. So the debt ceiling crisis has been resolved. Inflation seems to be heading in the right direction. The market seems to be pretty good with Fed policy. There's really nothing else on the horizon. We really see this data, this level of fear that has abated just over the past month very dramatically when we look at the VIX futures. So the S&P 500 has been very strong here. We broke above this level of 4,400 3 days ago. We were talking about 4,200 as being a very difficult level to get through. As we mentioned here, we said if we got through 4,200, we're going to go much higher. That will be the path of least resistance. So we're above a lot of companies, even the bullish. A lot of some of the banks and analysts that are out there, their forecasts were in the range of 4,300, 4,400. So we're above. So it'd be interesting to see what some of these big banks do in terms of reevaluating their numbers. But I think if we look at going back to this, the VIX futures data, we're seeing numbers that are multi-year lows. We got a print today of 1373 at the time of this. We got to go back to pre-COVID days to get to numbers that are like that. And we have had, numbers that were down in the 12s. You can see the low numbers down here. So we're not too far away from those lows that we had. Even there's a 10 that we had back in 2018. If we go back even longer, there were numbers, I can remember VIX numbers that were in the single digits. So down, 6, 7s. I've seen 7s in the VIX before. So this is a 20-year chart. So on this perspective, we could probably go lower. I don't know that there's so much value in going back and looking at the VIX 10 years ago because it's a different thing today than it was before. The biggest difference is that the VIX is something that can be traded since there are options on the VIX futures and VIX futures available. It has changed the behavior of the VIX. There's some value to it, but nonetheless, we see the VIX futures indication, and sort of another anecdotal evidence is if we looked at the term structure of the options for forward implied volatility for different expirations here. So this is a curve that is showing a very comfortable sort of level of fear in the market. So that's I put these things together. So combination of the debt ceiling resolution, the CME Fed funds tracker, the Fed announcement, and and then the big one, of course, is the volatility coming down here. I think that this is an indication that the path of least resistance here is at least not bearish. We've seen major moves in the SPX, and we're very significant levels of being overbought. Now, who knows? We can go higher and higher. There's no limit, no reason why we can't. But when we tend to get to these levels, when like the RSI, the Relative Strength Index, gets above this 70 level, it tends to be mean reverting. This is a stochastic indicator, meaning that it usually averages in the middle. So we get an average usually about 50, sometimes referred to as an oscillator. And I don't know that the average is exactly 0.5, but we do see that there's times above and below. When we get too far in one direction, it's almost like a rubber band that's going to pull things back. So when I look at the SPX, the S&P 500, and then the NASDAQ, the NDX index, we see very similar charts, very similar levels here that from a technical standpoint may give you an indication that there's time for a reversal. I think taking the data that we've seen the substantial sort of pivot with the resolution of the debt ceiling, and then getting sort of a level of confidence with the Fed, I think the IWM, or the Russell 2000 index, is probably the next index to go, to take off. I'm bullish on the Russell. We did break it out of a chain, out of a trend here recently. These are smaller cap companies that are probably more sensitive to the economy. There's still a forecast for a recession, but I think we're starting to see organizations revise their forecast. Goldman Sachs has lowered their probability of a recession in the next 12 months again to 25%. They're on the low end in terms of other organizations. I don't believe we're going to see a recession in 2023, maybe in 2024. I think the college debt issue is something that's going to be very significant. We'll talk about that maybe in a later episode. I've been dicing and slicing and looking at some of the data there, and that's really not going to become a problem until September. So I think between now and at least for the next quarter, I think the path of least resistance is up. I think bullish to stagnant trades are probably the way to go. That's about all I wanted to talk about today. I just wanted to touch base with people and share those thoughts. Greg and I had some conversations, but he really wasn't up for talking much today. So he said, why don't you go and do a everyday trader for people? So hopefully this information is helpful. Stick around the community. We'll talk about some ideas on how we trade it, and look forward to seeing you all later. Thanks for taking time.